I want to talk about this concept of independence in appearance and independence in fact. Independence in appearance is easier in a way to identify. You can identify if an auditor has violated their independence or impaired their independence because they own stock in a company or because a spouse owns stock in a company, right? That's it, because there's some output, some that you could see, right? You could test. There's something that you could say. The standard says you can't own stock. You own stock. You violated your independence. It's a little, independence in appearance is a little bit more objective, right? In determining whether or not independence have been impaired. Independence in fact, though, is very subjective and much more difficult to identify, right? So it's a very gray area, and it's an area that really people or regulators make that assessment after something has happened. So it's an after the fact kind of hindsight look back at independence being impaired. So one of the things we would ask ourselves is, you're an auditor. You're an auditor. It's, you know, you have this big client bringing in, generating a lot of fees. Do you think an auditor might impair independence to keep the client? How might that manifest itself? What kind of things would maybe raise a red flag that would suggest that the auditor impaired their independence, and why? What do you think? Independence in fact.
Maybe the time they've been working with a client.
So tenure?
5 to 10 years.
So audit tenure? But so the fact that an audit firm has worked with a client for 10 years, it's a long audit tenure, doesn't mean the auditor has violated their independence. But what might be a red flag to make you think that an auditor possibly impaired their independence because of those types of things, their relationship, their long-term relationship with the client?
They have formed some kind of relationship with management since they are constantly saving every year. Therefore, they may mess something.
Right, that's what I want you to get. There's an action, right? Something happened, right? Jimmy, what are you going to say?
Are they supposed to have a full period?
We'll talk about that. So you're talking about rotation. We'll talk about that in a moment, right? That's to address this issue of independence in fact, right? So the issue with independence in fact is that it kind of gets at these things. Okay, let's take Enron. And none of Anderson's employees or none of the people on the audit engagement did they, to my knowledge, they didn't violate independence and appearance. They had no stock in the company, no direct financial interest in the company. I don't think any of their, the covered members did. What the regulators got at was that you allowed things to happen. You did not, what do we say about professional skepticism? They did not have a sufficient level of professional skepticism, this questioning mind. They didn't make a critical assessment of the evidence. Right? They allowed, they allowed them to, even though they disagreed with, or initially disagreed with the way that the Enron was accounting for these related parties or SPEs, they let it pass. They allowed Enron to do it. So for a reasonable person kind of looking in, right, after the fact, I think most people kind of concluded that they impaired their independence, or at least it appeared that they impaired their independence in fact. Right? That they, because of the relationship that they, so you look at the types of incentives that auditors have, right? We talk about management's incentives to manage earnings, but the regulators are looking at auditors' incentives to side with the client, to bias their opinions in favor of the client, especially in these areas where we have a lot of subjectivity. And some of the things that you can't, how do you regulate that? That's very difficult to regulate. So this is what so in order to try to mitigate these situations that auditors find themselves in where they might, be incented to impair their independence, right? The regulators have prohibited certain services, such as internal audit outsourcing. They've really confined the amount of consulting services or the types of consulting services that auditors could perform. And their rationale for that was that, in addition to, the crossover of those services might be creating situations where the auditors actually more involved in the preparation of financial statements than they should be, or decisions. But the other thing is the vast amount of money that the audit firm is getting from these consulting firms, from these consulting services, and a lot of times, especially when you talk about systems implementation and design, those fees could far outweigh what auditors were getting for audit fees. Also, clients were pushing back on audit fees. They're like, look, you've been doing this audit for 10 years, same people, you shouldn't charge us this amount of money. So clients were giving pushback on audit fees. And so the money that, not that they weren't making money off audits, but they were really making a lot of money off of consulting services. So regulators felt like, look, they didn't want to lose the consulting services, and that's a carrot that, this client, or stick that the client can hold over their heads, and they're aware of this. So let's prohibit these types of services, right? The other thing is this rotation, right? Mandatory rotation, and that gets to both what Jimmy and Ella were talking about, is because of your audit tenure, and you've formed the relationship with that client. Maybe you are a little too comfortable. Maybe you're not as skeptical as you need to be. You build trust. And it's ridiculous to think that if you're going to be on an audit for 10 years or 7 years, whatever, that you're not going to form relationships with your clients. And it doesn't mean that, you just, if the person is a good person, you like them, you have similar interests, and, maybe your kids even go to the same school, right? You don't know. You're a human being. So you're going to have a relationship, form some type of relationship. It's not going to be an adversarial relationship. And so then maybe you let your skepticism, your guard down a little bit. So partners have to rotate off of the audit client. Not the firm, the partner, the lead partner, the engagement partner. So these are the types of things that the regulators have instituted to try, or implemented to try to get at this problem of impairment of independence in fact, because it's very difficult to regulate. You can't regulate independence in fact, because only an auditor truly knows whether or not they violated independence in fact. Right? Because only an auditor knows if they allowed their own incentives, their relationship with the client, their concern over maintaining that client as an audit client, or the possibility of more business from that client. Only the auditor knows if they allowed that to color their judgment. You or I can only assume that after the fact. If something happened, or we're looking at this and say, that doesn't make sense, and here are the reasons why it doesn't make sense, and here's why the auditor did it. We can only assume that after the fact. Regulators can only assume that after the fact, right? You can't regulate it. So that's why you see some of these. Another thing, and we'll talk about this a little bit more when we talk about audit reports, but now there's this proposal by the PCAOB to change the audit report, right? Because right now the audit report's one page, and and it says what it says about whether or not the financial statements are in accordance with generally accepted accounting principles, free material misstatement, reasonable assurance, and all of those buzzwords, right? Now they're talking about actually including a discussion of critical audit issues encountered. So twofold. One, to create greater transparency for the users of the financial statements, but also the auditors now have to disclose this information in the audit report. There's greater accountability, right? So now there are more people reading this. It raises more questions. So again, they're thinking then auditors would be more skeptical. They'll be less, they'll challenge their clients more, right? Because now it's in the audit report. PCAOB now has oversight over the financial. Before, auditors, the audit profession was self-regulated. Now the PCAOB regulates them. So this is really the regulator's response, not solely for, but a great deal of it is the concern is over audit independence. And it's not audit independence in appearance that they were concerned about. It was audit independence in fact. So make sure you understand the distinction between when an auditor between audit independence in appearance and independence in fact. The Standards 101 clearly addresses independence in appearance. Independence in fact is much more difficult. Okay.